So the next chapter is corporate restructuring. So let's see the LOSA. So explain types of corporate restructuring and issuers motivations for pursuing them. Okay. So as a large corporations, we have diverse lines of businesses under a common corporate umbrella. This can yield benefits called synergies. Suppose there is a company. So this company invest in various businesses. Various businesses like they operate in banks, they operate in manufacturing, they operate in telecommunications, they operate in paper industries. So this is the example of a large corporation. So there are two types of synergies. One is cost synergies, which is known as lower expenses. It can arise due to economies of scales. Suppose the company has achieved economics of scales, so they will experience lower expenses by eliminating redundant functions. Suppose a company has acquired another company. Suppose a bank acquires another bank, so they will won't require two ATMs at the same locations. So they can eliminate and increase their market share. Okay. Second one is the revenue synergies. That is, the sales is been increased. This can be achieved from economics of scope. Means when company uses its resources efficiently using the same assembly line for production of cars and trucks, which were building two different lines earlier. Suppose there is a company, say Tata Motors. So before acquiring another company, which is a truck company, the Tata Motors used to build their cars on their assembly line, and then another truck company used to build their trucks on another assembly line. So after acquisition of Tata Motors of another truck company, both trucks and the cars can be assembled on the same assembly line. Okay. Sometimes inefficiencies also occur, known as negative synergies. Suppose when the mergers or acquisitions happens, there can be negative synergies. So this arises due to diverse holdings, due to diseconomies of scale. Means the average cost of, so here we have written the definition of diseconomies of scales. Means the average cost of production keeps on increasing as company expand more due to slower decision making process and inefficiency in management system. So, which means there is no cooperation between two different management. Suppose one group is responsible for making cars, another group is responsible for making the engines, and they are not cooperating, so which leads to diseconomies of scales. So the manager alters businesses to reduce inefficiencies by three transactions. So we can reduce these inefficiencies by three transactions. Okay, so let's see how we can reduce. So the first is investment transaction. To invest in companies which creates a synergy. So we have to invest in those companies which will be beneficial. Okay, with our core businesses. Like a car manufacturing company should always invest in other businesses which is related to their core business, that is manufacturing of automobiles. So invest in companies which create a synergy with our core businesses to improve company ability to acquire resources. Main purpose to increase company size, that is capture more and more size of the market, to increase the revenue and to increase the profitability. Second corporate transaction is divestment. It's not disinvestment, it's divestment. So it is like liquidating or sell off companies underperforming non-core businesses which have low profitability and higher risk. Motivation is that it will reduce debt, it will increase the efficiency. Efficiency means how much return we are generating from a dollar we invest. Okay. So the best example is like the Wipro, which is an IT company. They also have other company which is making electric bulbs. So they don't have any synergies. So the best decision is to liquidate or sell off or to create another company of the electric companies. Okay, so like this, like both the Infosys IT and the Infosys, oh sorry, the Wipro IT and the Wipro electric bulb will be separated from each other, which will increase both. of the company's efficiency. The third one is restructuring. Here, no new investment or sell of an asset takes place. Okay. Here, the company size remains same in most of the time. Main goal here is to improve performance and competitiveness of the company with its peers. Let's see how we do this. So first one is the high security prices. This can drive corporate transactions from the given three transactions as markets are cyclical in expansion and contraction. First one is the CEO confidence in expansion. Everything looks good. CEO has great confidence that company will do good in the future also. So he does mergers and acquisitions or restructuring, like if companies like IT companies employed so many workers, like in the expansion phase, like in the year 2021, many companies hires ample amount of workforce. Second one is the low cost of capital. When stock prices rises, bond prices rises, and interest rate falls, then interest rate falls. So company can structure their finances. They can revise their debt with smaller interest rates. Okay. Uh, a study has says corporate transactions in weaker economics condition has given good results as comparison to strong economic deals. So why this happened? So like during a boom, everything is overpriced. Everyone has the market is so liquid. Like a non-performing company will also get ample amount of money. So and during the crunching, like during the economics, when the economic condition is weaker, uh, the strong companies which has a great business idea, great business model will stay. Okay. The third one is the industry shocks. This also leads to corporate transactions. These shocks are changes in regulatory advancement in tech. So the first shock is due to regulatory. Suppose new regulation has came that the mining industry has to follow these norms and regulations. So this will be a shock to the mining industries. Okay, advancement in tech. Suppose there was a typewriting company. Suppose there was a copywriting company, but due to advancement in tech like the chat GPT, the company can go bankrupt. Okay, or change in consumer preferences. Like earlier, people used to eat rice and wheat, but now people have different preference for eating. So as the industry grows, mergers tends to happen like Coke and Pepsi, Walmart and Flipkart. So categories of corporate transaction. First one is the investment actions. So three investment actions. First one is the equity investment. So like how a company can invest. So one is through the equity investment. Equity investment when someone purchases a stake of less than 50% from 0 to 50% in another company to gain some ownership or control. Here, investor mindset depends for the motive of investment, like he invested because asset was underpriced, or he want a seat at the board. So there are two motives for the investor to invest in a company as an equity investment. First one is the like the company is underpriced and there is a high growth potential in future, so that's why he invested. And second one is the he wants a seat at the board. So to gather more and more percentage, uh, they bought an equity investment in that company. Second one is the joint venture when two companies come together and use their resources to gain more market shares. As a big company, when wants to expand in foreign market, they do joint ventures with a small foreign company to get the knowledge, and they don't have to go from the scratch. Like they don't have to start from the very starting point. So they do joint ventures like both the companies have 50% shares, like many telecommunication companies like Idea and Vodafone has come and form a joint venture. That is V. Third one is the acquisition when investor acquires the company, that is it has more than 50% of the company he is acquiring. This is consolidation method, everything consolidated and minority interest excluded. So on the income statement balance, so on the balance sheet, you can see everything will be from the perspective of the investor who has acquired the company. And at the end, they have a minority interest excluded, which is not held by the parent company. So this was the three types of investment actions. First one is the equity investment, second was the joint venture, and third was the acquisition. Third, second corporate transaction is divestment, that is selling of subsidiary businesses. Like the Wipro has to sell off its electric bulb company. So like it is a sale of a division. Okay. Opposite to acquisition, there here we sell off a division to another party. Suppose the Wipro has sell off its division of uh, electric bulb to another company who was already in the market of electric bulbs. Okay. Second one is a spin-off. Say Infosys software company also subsidy of a printer production. So here we have taken examples of Infosys, which also is subsidiary of printer production. But now Infosys has decided to spin off the printer company. So here a new company will be created, printer company, which has its own employees, managers, board of director, etc. The owner of the Infosys share will also get a share of the printer company as dividend. This is done so both companies can focus on their core businesses. So for the previous examples of Wipro, the Wipro will create a new company like Wipro Electric, where both of the companies will have different employees, managers, and board of directors. So both of the company will lead to better efficiency. Third one is the restructuring. It can be opportunistic restructuring or forced restructuring. Forced, which will be forced, is related to like economic contraction. Or opportunistic restructuring means when there is a low debt or we get a good opportunity. Okay. So opportunistic restructuring takes place due um, to take place to improve companies' financial performances and increase return on capital, even though there are no difficult conditions. Okay. So it's a easy one. Like when the debt markets, like when the interest rates are falling, we can issue new debts and square of your previous debts, which was at high interest rates. Second one is the forced restructuring driven by external factors. Your company has no choices but to make changes in operations. Example, competition increases, demand of a product falls. Okay. Then you have to sell off unprofitable operations to remain competitive. Okay. If your company is not earning good amount in like during COVID times, like you have to shut down of your company, or you have to restructure your company, or you have to sell off your one division which is not profitable. So these are the examples of forced restructuring. So one is for the restructuring part, we have cost restructuring. This is done when company is underperforming. Okay, when the company is not performing well, there are two approaches. One is the outsourcing, and second one is the offshoring. So these two can be done to reduce their cost. Like we have to reduce the CUGS or the spends like we do in marketing and different on different expenses. So we have to reduce the cost. So one we can do is outsource your work, and second one is the offshoring. Let's see in detail. So like outsource your work of payroll or HR with a third party vendor to lower your cost. Suppose if you handle your own HR and payroll workforce, you will get a cost of $200. And if you outsource your work to a third party, they will get your work done at a cost of $100. So you will get a benefit of $20. So it's better to outsource your work. So here the third party will do your work. So here the main problem is data is unsecured. Like the third party knows everything about your company. Second one is the offshoring. So here we use migrant as your worker. We have to pay less, then our profit will increase. Suppose there is a Canadian company who works in Canada, and there they have to pay a salary of like 40 50 40 50,000 per year to their employee. If they get a same employee with the same skill set, In another company, say Bangladesh or India or China, so they have to pay less and the profits will gonna rise. Say Facebook, a US company, starts working in India, so they have to pay less salary. So this will increase their profits. Next one is the balance sheet restructuring, which is very much important. So first one is the sale and lease back. So here a company sells its own assets, say for 10 million to lessor X, and then take the asset for the rent from X paying 1 million every year for 10 years. Here company gets 10 million from X and also they do not have to compromise with their production. The lessor gets the benefits of rents and can use the asset for financial means. Suppose there is a company who wants the plant for 10 years and the company holds the ownership of that plant, but the company knows that in future this plant will be of no use. They only require the plant for only for 10 years, so they will rent or they will sell off its let's say they will sell off the plant to a person X, and they make a deal that the person X cannot lease to someone else for 10 years. They have to lease them back. So the company will get the plant for less lease for 10 years also, and they get the um, current market value of that land also. So that was the example. So they get 10 million for selling the asset and they have to pay 1 million every year. Okay. Next one is the dividend recapitalizations. So here, dividend paid using debt. Okay. It is generally used by strong companies who can take burden of extra debt. Here, company issues debt to repurchase its own share, that is increasing shareholders' wealth on the account of debt which is gonna rise. Well, the company is focused on their ratios, so the company can pay. So the company is paying the dividend with the help of debt. Next one is the reorganizations. When a company goes for bankruptcy, the court orders management how bankruptcy procedures will take place. Okay. Next one is the leverage buyout. Special corporate restructuring. In this, private equity firm purchases a public company for investment purposes and then selling of the unnecessary subsidiaries, like which is not creating efficiency for the company, which is a divestment, and they restructure the management and to increase the operation efficiency, like they remove the old employees and hire the new capable employees, which is the reorganization, and then exit via scale of public listing or sell off to another private equity firm. So that was LBO. And now moving to LOSP, here explain initial evaluation of a corporate restructuring. Investment analyst, they want answer for four questions. When conducting initial evaluation of a announced corporate restructuring, what, why, when, and is it material? That is the material. That is the information is material or not. So the analysts take informations from corporate press releases, security filings, analyst conference calls to get answers of what, why, and when, and is it material or not. So material, does this information can have impact on its share price or not. Okay. The analyst looks market reaction on the announcement of restructuring, which indicates whether value is created or destroyed. So next is LOSC. Here demonstrate valuation methods for methods. Interpret valuation of companies involved in corporate restructuring. So there are three approaches for valuation during corporate restructuring. First one is the CCA, that is comparable company analysis. It is used when an acquisition or a divestiture happens. Here, CCA, we compare the target company with its peers on its financial metrics and value the target company. CCA is mostly used in spin-offs rather than acquisitions. So here we compare the comparable companies. The advantages of CCA is getting peer group is easy to access. Suppose there is a spin-off in manufacturing company, so we look at peers for like how for to know at which rate we have to sell off our company. Okay. So getting peers is easy. Assumption of similar assets should have similar value. So like a manufacturing companies dealing in clothing industries, like the peers having the same asset as to the asset of our own company. Here asset value or market value. So here we take the asset values as market value. Disadvantage of CCA is takeover premium is not mentioned. During the private deal, we will not how much the premium the company has paid. No peer is available for target companies. Suppose there is a conglomerate like which deals in multiple businesses. So getting a peer of that company is not easily available. Second one is the comparable transaction analysis. So here we'll take the here we'll look on the transaction of the past in the past that has been happened. Okay. In this we see past transactions of takeover and compare the past comparable transaction with current comparable transactions. Okay. Here takeover premium is already considered in comparable transaction analysis. Advantages of this is actual data, no calculation of premium. Disadvantages is past transaction was appropriate or not. That is assumption. Like suppose a transaction that has happened 10 years back, and at that time the economy's growth was different as compared to today's growth. So not enough past CTA to compare. Okay. Historical transactions do not represent current conditions of economic growth and regulations. That is the main disadvantages of comparable transaction analysis. LOST, how corporate restructuring affects issuers, EPS, debt to EBITDA, and weighted average cost of capital. Combine acquirer and target companies' revenues. So here we're going to combine acquirer and target companies' revenues and combine operating expenses, combine depreciation, amortizations, combine other income and expenses, acquires interest rate plus interest paying by target company, estimate tax based on weighted average tax, number of shares outstanding plus additional shares of target company. Advantages of DCF is easy model change in cash flow. It can be modeled. So on the LOSE, evaluate corporate investment actions, including equity investment, joint ventures, and acquisitions. So first one is the equity investment. Okay. So alpha, a large mature company, beta, a new company with good growth year on year. Beta has zero debt, financials in millions or is of alpha and beta. So these are the net revenues, EBITDA, EBIT, interest, okay, all this is given. So alpha gives 1 billion to acquire 25%. So as it is less than 50%, it is an equity investment in beta. So alpha ranges 1 billion by debt. So alpha don't have money to acquire beta. So they have raised a debt of $1 billion. So the two companies agrees of 50 revenue sharing in a new service. They both agree to start CCA for beta in million. So here the CCA for beta. So there are the peers of beta, which is PQRS, and their enterprise values are this, and their net revenues are this. So as alpha invested in a growing business, and beta needs the cash to continue the growth. So the beta current market value is 4 billion. Market beta that has zero. Okay. So how we get the 4 billion? So like the alpha is giving 1 billion to acquire 25%. So for 100%, the market value of the beta will be 4 billion, and the debt is zero. So the enterprise value is 4 billion. Okay. Enterprise value of beta is 4 billion. So here the EV is not based on assets, only this premium is also paid. So to find out the premium, so the 4 billion of the beta is not solely from their assets only. Suppose their asset is 3 billion and 1 billion is the premium that has been paid by the alpha to beta. Okay. So to finding out the premium, we'll do the CCA. That is comparable company analysis. So we found out EV by using CCA method. So there is a comparable of beta PQRS. Their EBITDA is given, their enterprise value is given, and the revenue is given, and we have taken the ratios. So the EV by revenue ratios of P is 4.6, 9.1, 5.1, 4.9. So we'll get the mean of 5.925 and median. For median, we're gonna arrange in ascending order. So 4.6, 4.9, 5.1, and 9.1. So the median is 5. So the median is 5. Okay. So finding out EV with the mean, which is 5.925. Uh, so the beta EV by revenue will be, so it will be 5.925 into revenue, which is 720. So the EV will be 4.266 billion according to the mean method, and with according to the median method, we got a 3.6 billion. As we know that median is a better, median gives a better judgment of the company, because it also comprises of outliers. So the mean will consider this outlier, and median will ignore the outlier. Okay? So as median is more accurate than mean because Q is the outlier which increases the ratio. So true EV of enterprise value of beta is 3.6 billion, but alpha paid a valuation of 4 billion, which is approximately 11% premium. Okay. So the alpha debt to EBITDA ratio before acquisition of 25% was 8671 by 3297, which is 2.36, 2.63 times. So the after acquisitions, what we have here done is we have 8671 plus 100 would be, plus 1000. What was that 1000? So what we have done is 8671. So we have added 1000 and 3297. And we have added 202 by 4, which is the EBIT of uh, like 8671 plus 1000, like it is the given by the alpha to beta, and this is 202 by 4 is the EBITDA of beta, which is not to be added because it was an equity investment. This is true if alpha acquires more than 50% in beta, that is acquisition. So then only this consolidation will gonna happen. But it is was an equity investment, so this consolidation will not gonna happen. If alpha acquired more than 50% in beta, that is acquisition. Here it is an equity investment, so net income part will come in operating income. Okay. So that is not gonna 8671 billion, 8671 is the 8671 million was the previous debt, and 1000 is the 1000 million, which is 1 billion is the new debt. So this is not gonna this 202 by 4 will not gonna add. Let's see how we're gonna calculate. Here we're not gonna add the EBITDA of alpha to beta. Here alpha have been taken 25% of beta's net income. So we're gonna add 25% of 45 in EBITDA of alphas as it is shown in income from associates in alpha's income statements. So alpha new debt to net debt to EBITDA will be 8671 plus the 1000 million debt, which is 1 billion, to acquire the beta's 25% stake. So the EBITDA will gonna increase by 45 by 4 because it was the income from associates. Okay. So here the increase will be 2.63 to 2.92 times. Let's see what was 45 by 4. So it was a so what we're gonna do is we will not gonna add EBITDA of EBITDA to EBITDA. Okay, so we're not gonna do 3297 plus 202 by 4. We're not gonna add 25% of EBITDA of betas to alphas EBITDA. What we're gonna do is we're gonna add 25% of the net income to the EBITDA of alpha. So it will be 3297 plus 45 by 4, which is a 25% of net income of beta. So if you are calculating using equity investment, this is how it should be done. And if you are using acquisition method, then everything will be consolidated. Like it will be 3297 plus 202. And at the end, it will be minority shareholders interest. That's what it was 45 by 4. It will be income from associates. It will be mentioned in detail in FRA chapters. Second one is the joint ventures. Joint ventures, the account for joint venture will be same as equity investment. All the transactions made by them will be reported in their own financial reports, part of net income as their income from associates. So the account for joint venture will be same as for the equity investments. So so it will so there also we're gonna add the part of the net income to their EBITDA of the acquirer. Third one is the acquisition. In acquisitions, line by line consolidation of the investors, uh, financial statement with the financial statements of subsidiary with recognition of non-controlling interest in consolidation financial statements. Okay. So company A has a revenue of 100 and company B has a revenue of 10. So after acquisition, the company A will show a revenue of 110, and at the end, they're gonna introduce the non-controlling interest. So while evaluating a acquisition, an analyst should consider impact of synergies on profitability ratios, return on equity, return on investment, leverage ratios, debt rating if changed, then cost of capital change, impact of transactions on diluted EPS, because acquisition can dilute the EPS of acquiring company. How much premium paid on stock price. So evaluate corporate divestment actions, including sales and spin-offs. When there is a sale of a segment of a company, we should look into the value of a segment is sold at a fair market price and the impact of the sales on company's profitability ratios. We can use EV by EBITDA, that is enterprise by EBITDA for market value calculation. For spin-off, no good model is available. So evaluate cost of balance sheet restructuring. Evaluating restructuring announcement involves pro forma financial statement that reflect our expectations about cost savings, generate pro forma values to calculate relevant ratios. Okay. So evaluation during acquisitions through the calculation of consolidated EPS. Okay. So the net income of acquirer, that is the company A which has a revenue of 100, plus we want to add the net income of the acquired company, that is the company B which has a revenue of 10. Then what we're gonna do is we're gonna add the synergies and subtract the depreciations interest. So here, so this is the main formula. So this is the formula that below this line is the calculation of synergies. The synergies is revenue minus depreciation minus interest and tax rate. So this will be the additional net income. So what we'll want to add is net income of acquirer, net income of acquired companies, and net will be net income third. The net income third is the synergies. The EPS will be net income 1 plus net income 2 plus net income 3 and divided by the shares of the acquiring company. So here we will not gonna add the share of the acquired company. Suppose company A has a shares of company A has 100 shares. After the acquisition, company A will always have 100 shares. So the net income 3, which is the synergies, the formula of synergies minus depreciations minus interest minus taxes. That is for calculation of EPS, net income upon number of shares outstanding. Net income one is the that is of the acquirer company plus net income two is the acquired company plus benefits, that is net income three, which is synergy of revenue minus depreciation minus tax. Okay. So here the chapter ends. Thank you.